with regard to the main issues that treasuries face today, I would say it is actually preempting the volatility in our economic environment. That's one thing. And the second thing is that they need to confirm that the policies that they have got in place, which are often prepared in a tranquil environment, are still applicable for the specific conditions that they want to apply them. With regard to the implications of the euro crisis on FX volatility, I would say the following. The volatility starts to, the correlation between currencies outside of the euro and the euro itself starts to converge in moments of real crisis of the euro. That has happened in 2009 to 2011, and it is happening today again. So some of the policies that are based on holding a basket of currencies that are not fully positively correlated starts to fall by the wayside as a result of this phenomenon. What can treasuries do to mitigate FX risks? I think there are a number of things that they can do. Firstly, to have simple policies in place that give clear guidance to the businesses at how to deal with the three different currency exposures that they have. Transaction exposure, economic exposure, and in net investment exposure. Simplicity will lead to higher compliance. Secondly, what you need to do is to look at your organizational setup. What entities do you have, in which currencies or in which countries have you got exposure, and how can you structure those entities and the flows between the legal entities of your group in such a way that you actually can improve the offset opportunities that you have and the overall management and visibility of your both transaction and economic exposure. With regard to net investment exposure, there is an opportunity to manage that exposure downwards by actually entering into local borrowing. Naturally, that has to be done in the context of local interest rate levels and in the context of the actual net investment exposure that you hold in that particular currency. What processes, people and systems are relevant for FX management? Naturally, it is the Treasury staff that is key to this process. They are the ones that can actually lay off the FX exposure into the market. With regard to processes and systems, I would say the trading platforms that you have seen emerging over the recent years are key. That combined with straight-through processing will give you the upper hand, both from a bidding perspective and getting the lowest possible margins in the market, as from an efficiency perspective within your company when processing these trades. The most important thing that I've been taking away from this forum so far is the very interesting information divulged by the lady from the ECB. She had some very insightful slides on the build-up of further exposures to the so-called PIGS countries as a result of their inability to properly access market funding. An exposure that runs into the hundreds of billions of dollars and actually has been, at least to my knowledge, quite invisible to the outside world so far.